I learned early, too early, perhaps, that the market does not care about how right you feel. It only cares about how much you risk when you decide to act. You can be correct in your opinion and still lose money, and you can be wrong in your opinion and survive to trade another day. That difference, my friend, is not prediction. It is position sizing. Have you ever noticed how some men can be wrong again and again, yet they are still standing, while others are right once and vanish from the tape forever? The number one rule for position sizing is this: never risk so much on any single trade that it can impair your judgment or your future opportunity. That rule was written into me by loss, not by books. I did not learn it from a lecture. I learned it from watching my capital disappear when my size was too large for my nerves. And when a man's nerves are gone, his judgment soon follows. Have you ever tried to think clearly while your account is bleeding faster than your mind can reason? A trader must always remember that the market offers endless opportunities, but his capital does not. Capital is finite, and confidence is even more so. When you take a position that is too large, you are no longer trading the market. You are trading your emotions. The price ticks against you, and suddenly every small movement feels personal. You begin to hope instead of observe. You argue with the tape instead of listening to it. Is that trading, or is that gambling dressed up as analysis? I have said before, and I will say it again in another way: the market is never wrong, but opinions often are. Position sizing is how you survive being wrong. It is your insurance policy against human fallibility. When I put on a trade, I already know how much I am willing to lose if the market proves me mistaken. That loss is not a surprise, it is a business expense. And because the size is proper, I can take the loss without flinching and move on to the next opportunity. Can you honestly say you plan your losses before you enter, or do you just hope they won't come? Many traders spend all their time searching for the perfect entry. They draw lines, count indicators, and wait for confirmation from every corner of the chart. Yet they give little thought to how large they should trade. That is like building a fine ship and never checking how much weight it can carry before it sinks. The size of the position determines whether you stay afloat in rough waters, and the market, make no mistake, is always rough at some point. I never believed in betting the farm. The farm must be protected first. You see, a trader's greatest asset is not his system or his cleverness. It is his staying power. If you size your position so that one trade can cripple you, you have already broken the most important rule. I have watched men make fortunes and lose them because they forgot this simple truth. They thought the market owed them something because they had been right before. Does the market ever remember what it did for you yesterday? Proper position sizing keeps you humble. It forces you to respect uncertainty. Even when everything lines up, trend, volume, timing, you must still admit that the trade can fail. That admission is not weakness, it is professionalism. When your size is right, you can sit through normal reactions without panic. You can give the trade room to work. You are not shaken out by every minor fluctuation. Have you noticed how the best trades often require patience more than brilliance? There is also a matter of rhythm. Trading is not one trade, it is a series of trades over time. Position sizing ensures that no single trade dominates that series. You want consistency, not excitement. Excitement is expensive in this business. A steady, manageable exposure allows you to compound your gains when you are right and limit your damage when you are wrong. That is how accounts grow quietly without drama. Isn't quiet growth preferable to loud ruin? A man who understands position sizing sleeps better. He reads the tape with a clearer mind. He is not tempted to move stops out of hope or add recklessly to a losing position out of pride. He knows that his job is not to win big today, but to be able to trade tomorrow. Wealth in trading is built the same way it is built anywhere else, by protecting principle and letting time and discipline do their work. Why rush when the market will still be here in the morning? I have always believed that big money is made by sitting, not by trading all the time. But sitting is only possible when your size allows it. If your position is too large, you cannot sit. You are forced to act, to interfere, to second guess. Position sizing buys you the luxury of patience. And patience, in my experience, has paid more dividends than any clever trick I ever learned. Remember this, the market can stay irrational longer than you can stay solvent, unless you control your size. That sentence alone has cost and saved more money than most trading books combined. Control your size, and you control your risk. Control your risk, and you control your future in this game. Lose control of either, and the market will teach you its lesson without mercy. So when you next look at a chart and feel that familiar pull to go in heavy, pause for a moment. Ask yourself not how much you can make, but how much you can afford to lose and still think clearly. That question, answered honestly, will tell you the correct size every time. And if you cannot answer it, you are not ready to trade that position at all. Because in the end, the first duty of a trader is not to make money, but to avoid losing it in a way that puts him out of business. Everything else comes after that, quietly, over time, as the tape unfolds and opportunities present themselves again and again. The market offers endless trades, but your account has limits. That truth sounds simple, almost too simple, yet it is the one most traders spend their entire careers trying to unlearn. I learned it the hard way, as most men do in this business, by confusing opportunity with obligation. Just because the market is open does not mean you must act, and just because a setup appears does not mean you must take it at full size. Have you ever noticed how the market keeps moving along whether you are involved or not? Opportunities come and go like waves, and the ocean does not dry up because you missed one, but your capital can dry up very quickly if you treat every trade as though it were the last train out of town. A trader who understands limits knows that his account is his lifeline. It is not a scoreboard for his ego, and it is not a tool for proving how smart he is. It is inventory, working capital, and insurance all at once. Lose it, and the market might as well not exist for you at all. Many men fall into the trap of thinking that, because the market presents infinite possibilities, they must exploit as many as they can. They trade too often, too large, too aggressively, always afraid of missing something. But missing trades has never ruined a trader. Overtrading has. The market will be there tomorrow, next week, and next year. Will your account be there with it? That is the question most traders avoid asking until it is too late. I have watched men spot excellent opportunities and still fail because they forgot their limits. They saw a clean trend, strong volume, and favorable conditions, and they assumed that the market owed them a big win. They forgot that even the best-looking trade can fail. When they sized too large, that failure did not just cost them money, it cost them confidence. And once confidence is shaken, every future decision becomes suspect. Have you ever tried to trade well while doubting your own judgment? The disciplined trader treats capital as something to be guarded, not gambled. He understands that the market's generosity is irregular and unpredictable. There will be periods when opportunities are plentiful and periods when they are scarce. That is natural. What must remain constant is respect for limits. You do not press simply because the market is active, just as a merchant does not buy unlimited inventory simply because customers are walking past his shop. Your account has limits in size, in drawdown tolerance, and in psychological endurance. Ignore any one of those, and the market will expose you. A trader who risks too much on the belief that opportunities are endless is like a man who spends freely because he believes he will always have another paycheck. Eventually, something goes wrong, and the bills come due all at once. Does the market ever warn you before that moment arrives? Understanding limits does not mean thinking small. It means thinking long. The object is not to extract everything from today's move, but to participate in the market over many moves, many cycles, many years. That requires survival. Survival requires restraint. When you accept that your account is limited, you stop trying to force the market to deliver on your schedule. You wait for trades that justify their risk, and you size them in a way that keeps you solvent even if they fail. I learned that the market rewards those who last, not those who hurry. A man who burns his capital chasing every fluctuation will not be around when the real move comes. I have missed more trades than I have taken, and I am glad of it. Each trade I did not take preserved capital and mental clarity for the one that mattered? Can you say that every trade you take deserves a piece of your limited capital? When you truly grasp that your account has boundaries, your behavior changes. You stop adding recklessly to positions that are not working. You stop increasing size out of boredom. You stop mistaking activity for productivity. You begin to see that restraint is not fear, it is intelligence. The market is not impressed by how busy you are. It only reflects back the consequences of your actions. The illusion of endless opportunity tempts traders to forget that losses compound just as quickly as gains. A few oversized losses can erase months of steady progress. And once capital is reduced, opportunities shrink with it. Your size must decrease, your flexibility narrows, and your confidence takes a blow. That is how traders get trapped in a downward spiral, not because the market stopped offering trades, but because their account could no longer participate properly. A trader who respects limits understands that preservation comes first. He does not try to recover losses quickly by increasing risk. He accepts that setbacks are part of the business and that the market does not need to be conquered, only navigated. That mindset keeps him alive in the game, alive long enough to benefit from the next favorable cycle, the next sustained trend, the next moment when patience pays. So every time you feel the urge to press harder, because the market looks generous, remind yourself that generosity is temporary, but limits are permanent. Your account does not reset after a bad decision. It remembers every mistake. It carries the weight of every oversized trade. And while the market may offer infinite chances, your ability to take advantage of them depends entirely on what you have left to work with and how carefully you choose to protect it when the temptation to reach grows strongest and the tape seems to invite you in just a little more than your limits allow. Risk control matters more than perfect entries, and that is a lesson the market teaches slowly, painfully, and repeatedly. Most traders come into this business believing the opposite. They think if they can just find the exact moment to buy or sell, everything else will take care of itself. I believed that once too. I chased the perfect price like a man chasing a shadow, always convinced the next refinement would make all the difference. Have you ever noticed how much time is spent trying to be precise, while so little is spent deciding how much to risk? The truth is, a perfect entry does not exist in the way most men imagine it. Prices move, they hesitate, they deceive, and they reverse without asking permission. Even the cleanest setup can turn against you for reasons no chart can explain. When that happens, your entry price becomes far less important than how exposed you are. If your risk is controlled, a poor entry is an inconvenience. If it is not, even a good entry can become a disaster. I have entered trades too early, too late, and sometimes at prices that looked foolish in hindsight. Yet those trades did not ruin me because I controlled my risk. I knew where I was wrong, and I knew how much it would cost me if I was wrong. That knowledge gave me clarity. Without it, every tick would have felt like a threat. Do you trade with that kind of clarity, or do you rely on the hope that your entry will save you? Many traders wait endlessly for confirmation, afraid to pull the trigger until everything aligns perfectly. When they finally enter, they do so with sighs, convinced that certainty has arrived. But certainty never arrives in the market. What arrives instead is volatility, and volatility does not care how confident you felt at the moment of entry. If your size is too large, volatility will shake you out or force you into mistakes you never planned to make. Risk control is what allows a trader to operate in an uncertain environment. It accepts uncertainty instead of fighting it. When you control risk, you no longer need to be right immediately. You can be early and still survive. You can be slightly wrong and still stay in the trade long enough for the larger move to develop. That is how real money is made. Not by perfect timing, but by endurance. I have seen traders with brilliant entries lose everything because they could not manage risk. They moved stops, added to losers, and refused to admit they were wrong because their entry had been too good to fail. Pride crept in where discipline should have been. The market punished that pride without hesitation. Have you ever defended a losing trade simply because you liked the way you entered it? A trader who prioritizes risk control understands that his first job is defense. Offense comes later. Protecting capital is not exciting, but it is essential. You cannot compound gains if you are constantly repairing damage. You cannot think clearly if you are worried about survival. Risk control creates stability, and stability allows you to act rationally when opportunity appears. Perfect entries appeal to the ego. They make a trader feel clever. Risk control appeals to the professional. It keeps him in business. The market does not reward cleverness nearly as much as it rewards consistency. A trader who manages risk well can make money with average entries. A trader who ignores risk will lose money even with excellent ones. That is not theory, that is observation. When risk is properly managed, losses become routine. They no longer carry emotional weight. You take them, record them, and move on. This emotional neutrality is impossible if you are oversized. In that condition, every trade feels like a verdict on your ability. You begin to need the market to agree with you, and the moment you need that, you have already lost control. Entries matter, of course. They should be logical, disciplined, and based on sound reading of the tape. But they are only one part of the equation. Risk control determines how that equation behaves over time. It smooths the curve. It reduces drawdowns. It gives you room to learn and adapt. Without it, the learning curve is short and often terminal. I learned to ask myself a different question before entering a trade. Not, is this the perfect spot? But what happens if I am wrong here? That question changes everything. It shifts focus from prediction to preparation, from ego to responsibility, from excitement to professionalism. And once you see trading through that lens, you stop obsessing over precision and start valuing durability. The market will never reward you for how accurate your entry looked on a chart after the fact. It only rewards what you can hold, what you can survive, and what you can repeat. Risk control is what makes repetition possible. It is the quiet force behind every long-term success I have witnessed, and every failure I have studied traces back to its absence. So when you watch the tape and feel the urge to wait for the flawless moment, remember that no moment is flawless. What matters is whether you have defined your risk so clearly that no single moment can do lasting harm. Because trading is not about being right once, but about staying right enough, long enough, with enough capital intact to recognize when the market finally aligns in your favor and gives you room to act while still leaving you room to be wrong again. Position size decides whether you think clearly or emotionally, and that single fact separates traders who last from traders who burn out. I have seen it play out more times than I can count. Two men can look at the same chart, take the same trade, and get entirely different results. Not because one was smarter, but because one was sized properly and the other was not. Have you ever wondered why a trade that looks fine on paper feels unbearable once you are in it? When your position is too large, the market stops being information and starts being a threat. Every tick against you feels louder than it should. A normal pullback feels like a warning. A pause feels like danger. Your mind, instead of reading the tape, begins to argue with it. You start imagining outcomes instead of observing price. That is not because you lack discipline. It is because your size has taken discipline away from you. I learned early that fear does not come from uncertainty alone. It comes from exposure. The market is always uncertain, but fear only appears when the consequences of being wrong are too great. If your position is sized so that a loss would damage your account, or worse, your confidence, then fear is unavoidable, and once fear enters, clear thinking leaves. Can any man make good decisions when he is afraid? A properly sized position keeps the mind steady. It allows you to watch price move without reacting to every fluctuation. You can wait. You can let the market show its hand. You are not forced into action by discomfort. That comfort is not laziness, it is control. And control is what allows a trader to follow his plan instead of abandoning it at the first sign of pressure. Emotional trading is often blamed on weak character, but more often it is the result of oversized positions. Even disciplined men crack when the stakes are too high. I have known traders who followed rules perfectly until they increased size. Suddenly rules became flexible, stops moved, losses were justified. The same man, the same system, but a different size produced a different trader altogether. Does that not tell you where the real problem lies? When size is correct, losses are accepted quickly. They do not provoke revenge trading or stubbornness. They are simply part of the business. But when size is excessive, losses feel like personal failures. You want to win back what was taken. You want to prove something, to the market, to yourself, to anyone watching. That desire clouds judgment faster than ignorance ever could. Clear thinking in trading is fragile. It must be protected. The market constantly tests your patience, your confidence, and your beliefs. Position sizing is the shield that absorbs those tests. Without it, every trade becomes a psychological battle. With it, trading becomes a process. You execute, observe, and adjust, rather than react and regret. I have always believed that a trader should feel almost bored while in a trade. If you are excited or terrified, your size is wrong. Emotion is a signal, and most traders ignore what it is telling them. It is not saying the market is dangerous, it is saying your exposure is excessive. The market has not changed, only your vulnerability has. When your size allows clear thinking, you can do the hardest thing in trading: nothing. You can sit through consolidations. You can endure false moves. You can hold a winning position without grabbing profits too early out of fear. That ability alone is worth more than any entry technique. How many good trades have you cut short simply because the position felt too heavy? A calm mind also allows honest evaluation. You can admit when a trade is not working. You can exit without hesitation. You are not emotionally invested in being right. Oversized positions create attachment. Proper size creates objectivity, and objectivity is the foundation of good decision-making. The market does not reward intensity, it rewards patience and consistency. Clear thinking produces both. Emotional thinking produces urgency and impulsiveness. One builds accounts slowly and steadily. The other creates sharp rises followed by deeper falls. The difference is not market knowledge, it is position size. I have often said that the game of speculation is a hard one, not because it is complex, but because it is human. We bring fear, hope, pride, and regret into every trade. Position sizing is how we keep those traits from dominating our decisions. It does not eliminate emotion, but it reduces its influence to a manageable level. When your position is sized correctly, you can focus on reading the market instead of reading your own feelings. You watch volume, trend, and behavior rather than your account balance. You stop counting profits before they are realized and stop fearing losses before they occur. That shift in focus changes everything. The market will always test you. There will always be drawdowns, surprises, and moments of doubt. But when your size is right, those moments do not overwhelm you. You remain functional. You remain rational. And rational traders, given enough time and discipline, tend to survive long enough to learn what the market is willing to teach. So before you enter your next trade, consider not just the setup, but the state of mind it will force upon you. Ask yourself whether this size will allow you to think or whether it will demand that you feel. Because once emotion takes control, the outcome of the trade matters far less than the damage done to your judgment, and a trader without judgment is at the mercy of every price movement that follows. Staying in the game is the real edge in trading, and that truth is rarely appreciated until it is violated. Most men come into speculation believing the edge lies in insight, speed, or some clever interpretation of the tape. They look for the secret that will separate them from the crowd. What they overlook is that none of those things matter if you are no longer able to play. Have you ever noticed how many traders disappear quietly, not because they were foolish, but because they ran out of time and capital? The market is not conquered in a single campaign. It is endured. The man who stays solvent stays relevant. I have seen brilliant traders with sharp instincts vanish because they pressed too hard during a bad period. Their analysis was sound, their reads were accurate, but their staying power was weak. They mistook a temporary setback for a call to aggression, and the market answered with finality. The tape has no sympathy for impatience. Staying in the game means accepting that losses are part of the cost of doing business. It means understanding that drawdowns are not verdicts on your ability, but tolls you pay to keep operating. A trader who cannot tolerate losses will not last long enough to benefit from his gains. The edge is not avoiding losses entirely. That is impossible, but avoiding losses that remove you from participation altogether. I learned that survival precedes success. You cannot compound what you do not have. You cannot refine judgment if you are forced out of the market at the first serious mistake. Every lesson the market teaches is paid for in capital, and only those who remain can collect the education. How many lessons have you missed because you were too focused on winning quickly? The market favors the prepared, but it also favors the patient. Staying in the game allows patience to work in your favor. You see cycles repeat. You recognize familiar behavior in price. You learn when to act and, just as important, when not to. None of that knowledge is available to the man who exhausts himself early by trading as though every day were his last. There is a rhythm to speculation that only time reveals. Trends emerge, exhaust themselves, and give way to new conditions. A trader who survives through these changes gains an understanding that no book can offer. He learns not to force trades in poor environments and not to panic during quiet periods. That adaptability is an edge earned through endurance, not brilliance. Many traders mistake intensity for commitment. They trade too much, risk too much, and expect too much from every position. They believe that effort alone will be rewarded. But the market does not reward effort, it rewards alignment. Staying in the game long enough increases the odds that you will be aligned when opportunity appears. Burn out early, and you will never know how close you were. Staying power also protects your psychology. A trader who knows he can weather a losing streak does not fear it. That freedom from fear allows him to act decisively when conditions are right. The trader who is on the edge of ruin hesitates, second guesses, and misses opportunities because survival anxiety clouds his judgment. Which man do you think performs better over time? I have always believed that confidence in trading comes from durability, not from a string of wins, but from knowing you can survive a string of losses. That confidence is quiet. It does not boast. It does not rush. It simply executes when the time comes. And that kind of confidence is built only by staying in the game long enough to prove to yourself that you can endure. The market will test you in ways you cannot anticipate. Sudden reversals, false breakouts, long periods of inactivity, all of these are designed to wear you down. Staying in the game means structuring your trading so that these tests do not break you. It means respecting risk, managing size, and accepting that some periods are meant to be endured, not exploited. A trader who stays in the game learns humility. He learns that no method works all the time. He stops searching for certainty and starts preparing for probability. He understands that being wrong is not fatal, but being stubborn can be. This mindset does not come from success alone, it comes from survival through difficulty. I have seen traders quit after their first serious drawdown, convinced the market had changed or turned against them personally. In truth, the market was simply being itself. Those who stayed learned how to adjust. Those who left learned nothing except disappointment. The edge belonged not to the smartest, but to the most resilient. Staying in the game also allows compounding to do its quiet work. Small gains, protected and repeated, grow into meaningful results over time. But compounding requires continuity. Interrupt it with reckless losses, and you reset the clock. Worse, you may never get the chance to start again. So when you think about your edge, think less about how much you can make on the next trade and more about whether your approach allows you to still be here for the 100th trade. After that, the market does not need you to be heroic, it needs you to be consistent. And consistency is born from survival, from respecting the fact that this is a long game played in uncertain conditions, where the greatest advantage often belongs to the man who simply refuses to be forced out, who structures his actions so that tomorrow is always available, who understands that the ability to continue is itself the rarest position to hold, because once that position is lost, no analysis, no insight, no future opportunity can bring you back to the point where the tape is still speaking to you, and you are still able to listen and respond while remaining present in the game long enough to see what unfolds next.